If your company goes into liquidation and the books and records show that that loan is on the books and records, then it is tantamount to an admission that you owe that money back to the company, and a liquidator will certainly put their hands out for repayment of that loan. More often in situations when companies end up in liquidation, we find that there are loan accounts recorded where the director owes money back to the company. Now, it's an accounting regularity that payments that the company makes on behalf of the director get recorded as entries on a loan account, with the idea being at the end of a particular accounting or reporting period that there will be set up for either those monies to be repaid or for the benefit obtained by the director to be expensed as income.
It sounds so absurd when you're working in your business. You think you're drawing a wage or you're drawing some benefit, which financial benefit from you working in the business, and then you have this event where your own company is suing you to recover that money that you believe is wages. Then it seems like an absurd proposition, but it is a real proposition. It's cases that you and I have worked on, and it's something that you really need to be alive to, getting the right advice before you're putting the company into liquidation. Or if you are getting into trouble, go and see somebody beforehand. If there's debts that are owed and you've got creditors chasing you, then just assess where the business is at. Speaking to an accountant is a really important thing. I mean, a lot of the businesses we work with, they rely heavily on their accountant's advice. And I always recommend that. Don't put yourself into a little hole and bury your head down and think, I'm not going to deal with this, because it'll come back and bite you in the butt.
Yeah, well, a lot of directors find themselves in a position of director without really understanding the legal consequences of the duties that they've taken up. What they think is that the company's money is my money, and the two things are interchangeable. But much like when we talk about documenting loans that you've made to the company, the way in which you take money out of your company should also be documented. So if the company is paying you a wage, then it should be able to be seen that it's reported. You should maybe have an employment agreement with your company. Correct. By which your wage is set. Yeah. Or you should be able to establish a practice at the end of each reporting period at which any of the money you've taken out gets recorded against the income that you're drawing from the business. Otherwise, it sits there as on the loan account on the basis that it could be repaid at any time. Yeah,
absolutely. And I mean, no one loves paying tax, do they?
No, no one loves paying tax.
But we have to.
We all have to pay tax.
And it's part of our duties as a citizen to pay tax. So there's
for anybody from the ATO, we all have to pay our tax.
Oh, we do pay it, but we don't love it. So people then find themselves in a situation where they think, great, they're getting money in the hand, and they're not obviously declaring it yet as an income, and that sounds like a great situation where you're not yet paying your tax, but then it gets resolved sometimes as a director. They'll declare it as an income, and then they have to pay their tax. Doing that is an essential part of having good practice in your business, and will allow you not to get caught out. Now, if you are in unusual circumstances, we spoke about this earlier, and it's very uncommon, but if you genuinely thought that you were paying tax, and you were paying tax, but there's an irregularity in the documentation with your business, for example, you've got a bookkeeper who hadn't done the transaction, you could theoretically provide some evidence to show that you have declared that in your tax assessment and that you have paid the tax. That's very uncommon. That doesn't typically happen. But if otherwise you're not that organised and you genuinely haven't then declared the income and the business has been wound up, you have the risk of the liquidator, even if you've appointed them yourself, who has a duty to recover any debts the company owes, to go out, and it's very low-hanging fruit, as you know. Yep. So I can see in the bank, in the records of the business, a loan owed by the director to the business. They're going to go after the director, particularly if the director has assets. The first thing you'll do is a title search. Yep. And they'll say, great, there's a property, I'm going to get that property.
So low-hanging fruit, and I am a liquidator, so I can tell you that this is what happens all the time. All right, we are regularly appointed to companies, we are unfunded, we have obligations and tasks that we have to perform, and the easiest way to recover money into the company or into the liquidation to meet the costs that we've incurred is to simply issue a demand to the director for repayment of the loan account on the records that we've received. Yep. That's number one. Any type of additional claims, whether it be recovery of uncommercial transactions, insolvent trading claims, etc., there's quite often litigation, complex investigations that need to go into that. That can take time, it can be expensive. Whereas a director loan account, you can issue a demand for that on day one because the records show that the money is owing, and it's a very easy recovery by which liquidators get money into their accounts so that they can pursue recovery of other assets or recovery of other litigation. So you're 100% right. It is the first sort of thing that any liquidator is going to look at. In terms of the grossly unfair aspect of being a business owner, going back to what you'd said just before, the idea that many business owners forget that when you own a business, everybody else that is owed money by your company has to be paid before you get paid. Now, considering how hard business owners work in their business, that can sometimes seem grossly unfair, but that is the downside to being a business owner. The upside are many, and we've talked about them in many other videos, but the downside, the company can only afford to pay you what it could afford to pay you after everything else has been paid.
Yes.
And so if you're taking money out as income or in loans and leaving creditors unpaid, you're going to have to pay that back at some point.
Yeah.
So it's really important before allowing your companies to be wound up or putting them into liquidation themselves, or before implementing any restructure of your business's affairs, that you get the right advice from your accountants so that you know how all those issues are going to play out, so that you don't get surprised, much
Absolutely.
like you were saying.
I think you hit the nail on the head before when you said a lot of business owners see the business as an extension of them, and so there's often not that consideration of putting the right loan agreement, because it does seem absurd. I've got a loan agreement between my business, which is me, and myself. Well, the business isn't you, it's a separate entity. We're dealing with companies here. We're not talking about sole traders, we're talking about companies. So a company is a separate legal entity, and you need to treat it like a separate entity, like it's its own person almost. And then making sure that the transaction is properly documented is very, very important. And it's not even just for insolvency events. It's also can extend for if you want to sell the business. Do you have the right documents in place? Particularly if you're owed money and you want to then have that factored into the sale price. So it's not always doom and gloom. It sometimes can benefit you if you ultimately want to sell the business down the line.
So, Sarah, you've acted for both company directors and for liquidators. You act for company directors as well as liquidators. So let's have a look at some of the cases that you might have worked on behalf of directors. If a director has received a demand for repayment of a director's loan account, what are some of the defences that a director might have that might mitigate the requirement to make those repayments?
Great question. They're tricky cases, particularly if the records clearly show that there was money paid to the director, which is often the case. So you can show money out of a bank account. Some of the defences you can raise, obviously, is that it's not a loan. There's no terms of the loans, there's no agreement between the parties. If you can show that otherwise it was for business expenses related to the business and it wasn't meant to be applied to the right loan account, then obviously there's some scope to argue that the transaction's been improperly recorded and that it was otherwise a business expense, for example, which sometimes does happen where account bookkeepers are just putting things in different journals, but merely it's just attacking whether there's a loan or not. So every case stands on its own, and we have to look then what we can raise as to what actually occurred, and then obviously try to work with the liquidator as much as we can. And then if it does end up in court, we were talking earlier about the practicality of having to defend one of these cases. So what you can do instead is get the right advice, go to the right people, accountants, lawyers, insolvency practitioners for pre-insolvency advice, and find out what you need to do beforehand. And you're talking very low cost comparatively to then defending a claim against a liquidator who's wanting to then get funding to then fund the rest of the potential claims that they might have. So you spend $5,000 now on a proper loan agreement or getting advice from an accountant instead of spending $50,000 defending a claim and then potentially being unsuccessful and having to pay it.
So from the point of view, my point of view as a liquidator, two different outcomes that turned on a very small and minor point. In one matter, the pursuit of a director's loan account, we're able to show that that loan account had just grown year on year and was consistently being applied as a way of recording money taken out of the business by the director that was never really being intended to be repaid or otherwise dealt with. The director claimed that it was his income and relied upon, or attempted to rely upon, the fact that his accountant was supposed to be managing his affairs as well as that of the company, and therefore it was not aware that that was something that was expected to be repaid. Now, that isn't going to stand up as a defence at any point. Your accountants are there to help you, not to be relied upon to the point of neglecting your duties to the company. In another case, at the end of every financial year, there was transactions both ways on the loan account, but they were able to show that there was a history at the end of each reporting period in which whatever the balance of that loan account was then expensed to income in the next year. And so when the company was liquidated, whilst there was $300,000 sitting on the loan account, the history of the company showed that that would have been expensed as income, and that the directors would do that, and therefore it became a solid defence that those funds really were the income of the director and not a loan account, so and therefore not easily recoverable.
So there is scope to argue that it's not a genuine loan, but again, that's quite a difficult argument if there hasn't been any attempts to then reconcile it, or whatever the accounting terminology is, to then bring it from one account to another, then you declare the income. And in your instance, I mean, it's fantastic that occurred where you could show the history, but more often than not, there isn't. Particularly if you haven't done your tax in a couple of years. So, moral of the story, pay your tax.
Yes.
Get your tax sorted out.
Pay your tax. Absolutely. The quality of the records are really critical. It's an absolutely important way for you to protect yourselves. Maintaining those records and the importance of that, it really can't be overstated. And a really good point, something that we could take away from today's presentation is this. If you're a business owner, look at your accounts, and if you don't understand what they mean, make sure that you're talking to your accountant so that you do understand what it means. Don't be afraid to ask questions, and if you don't feel confident in the information being provided to you by accountant, get a second opinion. Okay, these things are too important to leave to chance. So,
and you should, if you're a business owner, you should have firstly a very good accountant, and secondly a lawyer, because you'll need to have documentation in place.
Shameless plug.
Very true though. You'll need to have the right employment agreements, you'll have to have the right loan agreements. If you're putting money into the business, you'll want to secure those loans. You want to make sure that you've got the protections in place, that if something does happen, then your personal assets are not going to be exposed. That's the worst thing that can happen for a director or an owner of a company. The whole point of a company is meant to be a limited liability.
That's right.
And then that extends beyond the scope of what the company is really, the protection that you typically get from having a company structure. But as you pointed out earlier, you can't run a company and pay yourself and ignore the other creditors. Do the right thing, get the right documentation, run the business in a way that allows everybody to get paid, and if you can't, make sure you're setting things up so that you're going to get an outcome that you're not surprised by. So typically the aspect is that they're very surprised, the directors, when it comes to it, and they get that demand from the liquidator saying, hang on, this was my wage, why am I having to pay this back?
So those upfront costs that you can pay now to set things up could pay massive dividends in the form of as much as an insurance policy would down the track if things go wrong and you're trying to rely upon those documents to verify what you did as the director of the company and the financial arrangements that you've entered into. The expenditure now to set up those arrangements and document them properly could be worth more than any insurance policy. So definitely worthwhile.
I just gave the advice to a young gentleman today. He's got a small business he opened and he was operating as a sole trader. He's engaging potentially in a dispute with a client, and my advice to him was ignore the dispute for now, get yourself set up properly. Spend the money on getting yourself set up properly so that you're not exposed.
Sarah, we quite often see when companies are facing financial difficulty that directors want to put more money in and they hope that that's going to solve their problems. But also in preparing for potential adverse outcomes, they may wish to take security in case their companies do end up in liquidation. What are some issues about directors creating and advancing more funds in times of financial difficulty, and what are the rules around the creation of securities in those circumstances?
So, great question, Liam, because I'm sure you see as well, sometimes you'll see a director or a business owner just whack on a PBSR it's a very easy process to do, to lodge. It's very inexpensive, it's like $10, $20, something inexpensive, and they think that's going to get me. It's similar to also when you can pop on a mortgage to somewhere, or caveat. People think very easy to do, and that's going to then allow me to get my money back as a priority. Of course, that doesn't work. You need to firstly have the documentation, particularly for PBSR, it must be in writing. It's called, typically people know it as a GSA or a General Security Agreement, which you need to then have to support the lodgement of the PBSR. So if that was to occur, you can't secure the old debts that you've already put into, or the old loans that you put into the company. So if you've put money into the company and wanting to then secure those loans with the company, you can't be doing that retrospectively. So you need to make sure that you're looking at it from the fresh perspective, or dealing with those as a separate consideration or a separate transaction and getting them resolved. And as you pointed out, sometimes there's preference claims that you can look at where liquidators have pretty vast powers where they can claw back funds, or they can I don't know, you tell me what you can do.
Look,
typically I'm trying to fight against that.
We typically look at them and say the creation of securities like that are avoidable if they're created at a time that the company was solvent. That's the word I was thinking of.
And
we toss those securities out and deal with them as if the security had not been created. So a takeaway or a really great piece of advice for anyone watching this: if your business is in some financial difficulty and you are looking at recapitalising it, I wouldn't be putting that money in without taking proper advice from an accountant, a lawyer, or a business advisor to make sure that you are securing your position in a right way, and that security is going to stand up in the event that things don't always turn out the way you want them to. You need to be prepared. You have to take responsibility to protect yourself.
Or you do it knowing you won't get the money back.
That's right. It is always a risk. Business is a risk, and that's the fun of being a business owner.
Just giving you a shameless plug now, Liam. I've had many a client who've been under immense stress trying to deal with all of the creditors who are trying to get them to pay. There is a tendency to want to put money into the business to try to keep it afloat, which is very noble, to try to keep moving, but sometimes it's a bit of a dead horse, and just coming to have a meeting with you, talking them through the process. You're not scary at all. You kind of ease their concerns, and a lot of them have said after the fact that it's been the best thing they've done, right? And it's not ideal to have a company being wound up or even some bankruptcy, but sometimes that relief, you know, that it's being taken care of and it can be managed, is the best outcome.
Well, we're pretty committed to some honest and frank advice here at O'Brien Palmer, and that's something that we can give back to anyone who needs some advice around addressing their issues. Sarah, thank you so much for coming along today. I really appreciate the advice that you've got for our viewers. Anyone who is interested, I'll put some details in the links underneath here and how to find Sarah up at Hickson's Hunt & Hunt. Get in touch, she's fabulous. And thanks so much for coming along today.
Thanks for having me.
No worries. Thanks, guys. See you soon. Edit for our camera lady, our camera person.
I'm a camera lady.
You're a camera lady?
Yeah.
Excellent. Defences.
Oh, defences. Sorry, I was like, I don't know what the offences are. Sorry, edit this out. I was like, I don't know what the offences are.
No. What else?
And you're like, what are defences? I was like, I don't want to tell you my defences.
No. And if you... No, I shouldn't say.
It's harder than you make it look.
What? I don't think it's hard. I was going to say, what are you talking about?
You make it look really easy when you do it, but then now I'm like, what is my mind saying?
Oh yeah, that was a really long-winded question, wasn't it?